welcome Mr. John Roll, the Financial Secretary in the Ministry of Finance. He has so kindly agreed to come and meet with us. I can only imagine what he's going through and the amount of questions and emails and nightmare, I guess, is what I would call it if I were him. But I would really like you all to welcome him warmly as he comes to enlighten us how VAT will impact our industry in the real estate industry and enlighten us as how moving forward we'll be able to educate our clients and customers as well as ourselves. Mr. John Roll.
Thank you very much. And I want to express gratitude to Bria for inviting us. I know we've had meetings at the level of the executives and getting some familiarity with the issues that are of concern for the Real Estate Association. We're particularly pleased that we're able to organize on such short notice this meeting for a Monday morning, not even being able to predict what the weather would be like. But we were supposed to begin our presentation this morning by taking you through some of the accounting side of that. So we would have had a third member of our team present to walk you through that. But we'll make amends and keep that aspect of the presentation less technical. What I will do is go through some of the general concepts related to VAT, and then turn to the presentation on issues which we know are more specific to the real estate industry. Now, if you're in the real estate sector, you should really be following what's happening in construction as relates to VAT, the hotel sector, particularly as relates to VAT, as well as to land and property, depending on the aspect of the business. So I think the presentation will touch a bit more on land and property issues. But I think the point that everyone understands now is that the VAT rate is 7.5%, and January 2015 is when the act will become fully into effect. In a matter of days, there will be some parts of the act that take effect early, which deals with registration, as well as some of the transitional provisions which are important for businesses, particularly where you have existing contracts. And the transitional provision also speak to the timelines that apply for registration on the onset of this reform versus the timelines afterwards. But you should know that the legislation is now enacted. It was gazetted about the 19th of September. And right now in the government, internally, all of the effort is making sure that the machinery to administer the VAT is fully functional and operational by January 1. We're also, through outreach such as this, making sure that we're getting back from the private sector and the feedback that's necessary to help us improve and clarify the various guidance notes that are being issued. And I think just in hearing some of the comments that are coming back from the real estate sector, we appreciate that we're going to have to do some extensive amount of work to clarify things in the guidance note that relate to the real estate sector. We always like to get started by being on the same page. So it doesn't matter whether it's real estate, the retail grocers, or the hotels. I mean, VAT is the same thing. It's the extra amount that's in the price that we pay, and it's being collected from us as consumers, because we should always see ourselves foremost in the shoes of the consumers. So whatever we pay, there is an amount of VAT in the price of the goods and services that we pay. That's being collected from businesses and passed along to the government. And the other case where we do see the VAT is when we import items, whether as consumers or as businesses, because customs is going to be the first line of defense in terms of collecting VAT at the border. The, the businesses really are no more, when you're VAT registrant, you're no more than the collections agent for the government. VAT is not for VAT registrant an expense for the business. The only amount that the business or the operation owes the government is the amount of VAT that the law says they're supposed to be collecting on their supplies, on their taxable supplies. So you collect the VAT on your sales or your rental, you owe the government that amount. But before you hand it over to the government, the law says there has to be a reconciliation so that you can now step back and deduct from whatever VAT you've collected amounts that you paid in the course of your operation. So you take back what we call your input VAT or your tax credits. This reconciliation is to ensure that the government never gets more from your business or your operation than you should be collecting from the customers. And the law says that when the reconciliation is done, only if what you've collected from the customers exceeds what you've already paid early on do you hand the government a difference. If it's less than what you would have paid early on, then by law the government owe you a difference, and that difference is provided back to you by way of a refund. You also must understand in your operations that the refund process is not a two-way street. It doesn't mean that you collect everything, give it to the government. Instead, when you collect, you do the netting. You do most of the reimbursement within the business yourself. So businesses do the bulk of the reimbursements internally. They don't pay the full amount to the government, then wait to get a check from the government for the difference. So the refund mechanism, for the most part, is the credit mechanism, which, if you're operating as a VAT registrant, that's where you're getting back most of your refunds. Now, if you are in the export sector, the law says, again, only what you are supposed to collect from your customers do you hand over to the government. So I use the example of electricity. So let's suppose the VAT on electricity was 30%, and you have to collect 7.5% VAT from your customers. That's all that matters. Now, if it so happens that 30% VAT on electricity is much more, or it pushes your payments above what you should be collecting from your customers, then you're in a net refund position. It could be 50% on electricity, and you may be one of those operating in a sector where all of your services are being provided to persons outside the country, and so the VAT rate for them to be zero. So if you're not supposed to be collecting any VAT, zero is the amount, and so you're getting full refund. So that's typically the position that most of our international businesses are in. Our offshore banks, also those who are primarily in the export business, whether they're going to be exporting crawfish or other fisheries products, if they are not having any sales locally, then they don't have any sales on which they should be collecting VAT. Therefore, they're getting back from the government the full amount. But as a business, what's important is that you need to know that whenever you make a claim or you take a credit for VAT, it's based upon you having the proper documentation inside your business. Now, one of the most important documentation for every business is the so-called VAT invoice. The VAT invoice is the proof that you paid VAT. Only VAT-registered businesses can issue VAT invoices. And only VAT registrants can use VAT invoices. A VAT invoice will have a TIN or a tax ID number on it, which will say you are you as a business person, and it would also have the TIN to say which business is giving you the receipt. That's what you use to claim back your credits from the government. If there's an audit of your business and the VAT officers come inside, they have to be able to reconstruct your VAT returns and your credits based upon those documentation. If you take it a step further, it means that anyone who's providing you services, whether it's landscaping, electrical, plumbing, etc., if they are your suppliers, then you need to make sure that they're VAT registrants, if they're charging you VAT, and that they're giving you the proper documentation to collect the VAT or to claim the VAT back from the government. So you really need to know, as suppliers of services, of real estate services, or any other services, who your suppliers are, whether they're VAT registered. Now, I don't think we should take it to the extreme. I know some businesses say they're only going to be dealing with VAT registrants. That may be fine, but let's think about the fact that it's Sunday morning and you got a busted pipe and you need to call a plumber, and it's maybe a $60 or $120 repair. You could well decide whether the guy you call is a VAT registrant or not, or whether it's more important to get the plumbing done, or if it's an electrical repair, whether it's important to get it done. But depending on the frequency of the work and the value of the contract, that could be an important thing. I personally don't think that when you go into the maintenance business, that a lot of these contractors will be beyond the reach in terms of keeping the proper records to be VAT registrants, even if they are small businesses and they are not mandatorily required to be registrants. But the bottom line is that in some cases, you may encounter service providers who are not VAT registrants. That's important because just because I'm not a VAT registrant doesn't mean that my prices are not going to change. Every business in this country is going to have to make some conscious decisions about their prices. If you're a VAT registrant, then the price difference will likely be the amount of VAT that's added to the cost of the services. If you're not a VAT registrant, you have no dealings with the government. You still have to adjust your prices because now VAT is a direct cost to you. You can't recover it. So that small plumber, electrician, or whomever, their price, their charges may go up. But their charges will not go up in a way that a typical business can now recover those as VAT inputs. So that's important to understand. Prices will adjust, but not every business that has adjusted or higher prices will be issuing VAT invoices, because if they're doing it and they're not VAT registrants, it's against the law, and the full penalties of the law will take their course. So on the business side, you have to know who these suppliers are. You have to maintain proper documentation, and you don't submit this to the government when you file your returns on a monthly, quarterly, or half-yearly basis, but the information stays inside the business. What you also need to know is that the other side of the public education process is making sure the consumer knows what they should be looking out for. Now, in the real estate sector, when we start to talk about the commercial side where VAT applies, your consumers will, for the most part, be, I guess, large store owners or small store owners who are renters. But outside of the real estate sector, all consumers will know that they're supposed to get VAT receipts. VAT receipts are different from VAT invoices, and VAT receipts are still supposed to identify your business, provide your tax identification number, and in all cases show the amount of taxes that your business is paying. So that's very important. In the real estate sector, you also want to be very attentive to the transitional arrangement. The law says that all of those contracts which currently exist, there is no need to go back and write those over. As of January 1 and beyond, you can now add the VAT supplementary to whatever amount of rent or lease payments are being paid on those tenancies. So that's what the law says. You can recover the VAT as an addition. After January 1, any new contract, well, you better make explicit provision for it. Now, some of the contracts, you know, are already being very explicit in making mention of VAT, which is good. So I have seen this in the case of the real estate, even in terms of some of the rental agreements that the government is signing. And the government pays VAT. So if a government ministry or agency is a tenant in one of your properties and you don't collect the VAT from them, then it's tough luck, because the law also gives us a formula how we can go in and just take a slice of whatever the revenue income is that you're collecting and take it back when it's VAT. So there isn't a government agency that can present itself and say, oh, I shouldn't be paying VAT, because there is nothing in the legislation that says government is exempt from VAT. Exemptions only depend on what the service is. So you want to make sure that all of your commercial tenants are paying VAT, or you're collecting VAT from them, because your commercial income won't be separated between the two. As I move into the presentation, what I want to be very clear on is that the definition of commercial for VAT is not the same definition that the banks use when they decide whether your property is commercial, because commercial property in the banking sense means also residential units beyond a certain number of units. Anything that's housing, where there's a 100-unit condo complex and it's being rented, or a single housing unit, under that, that's still dwelling, that's still residential. They're all exempt from VAT. So it isn't the number of units that determine whether it's exempt. It's whether it's residential or not. It doesn't matter whether I'm staying in Atlantis, Bahama, or the Hilton. If I'm occupying the room for more than 45 days, then that switches from commercial to residential. So the litmus test for residential is the person going to be occupying the dwelling place for more than 45 days? So as a resident. So even in a hotel, so if somebody decides that they want to live in the hotel on a long-term basis, that becomes residential, and that becomes an element of the operations that are exempt from VAT. So that's important to understand in terms of what's happening in the real estate sector. So now I can speak a little bit more generally to land and property issues and the exempt versus taxable areas of real estate. I'll also talk a little bit about the special supplier rules, the VAT obligations, what's next, and a bit about some of the areas where I know BREA has flagged some concerns, such as CAM maintenance fees, payment of rent in advance, even VAT on property sales. So I'll flag some of those, and then hopefully, depending on how much depth of coverage, we can have some more discussion during the question and answer period. But once I'm done with this, you'll get a short presentation on the registration process, and then we'll open up for general question and answers. But for that purposes, we look at where the property is that's being supplied. That's important because we say that under the law, and it's very clear in financial services that are provided to non-residents for exchange control purposes, and everybody understands what that means, that you're a non-resident for exchange control purposes, even if you're a bank on the corner of Bay and Parliament Street and you're downtown. If exchange control says you're non-resident, then technically you're not in the Bahamas. So you're a non-resident for exchange control purposes. That definition in and of itself doesn't mean that non-residents don't pay VAT on real estate services. A non-resident that buys property in the Bahamas, they pay VAT on those transactions. So the second home sales and the like, wherever VAT comes into play in those transactions, that's happening in the Bahamas and is subject to VAT. When you have properties that may have a combination of commercial and residential, then how that applies in terms of the liabilities as well as how much credit you can claim is going to depend on how the property is organized. If it is such that you have very clear accounting so that you can separate the residential from the commercial side, then you can look at the commercial side in isolation and allow full pass-through of VAT credits. Or if it's a mixed use, there's reference in the legislation to apportionment. Basically, it means if 50% of the income on the property is for commercial, then only half of the VAT that associated with your inputs can be claimed back as credits. So apportionment may be very important depending on how properties are structured and the mixture of tenants that may be on those properties. The other thing that's important in terms of the VAT treatment, and this is not just in the case of real estate, whenever there is an asset or a business that is being used in a particular form and is converted to another use, that could be applied. So, for example, you will see in the legislation that if a business is sold and it continues to operate in the same fashion, it's zero rated for VAT purposes, meaning that any VAT that's involved with the transfer of the assets, no VAT is involved with the transfer of the asset. So the government would not expect it to receive VAT on the sale of a business where it's being sold as a going concern. And that would also include if it's a commercial rental property and it's just changing ownership and it's going to stay in use as rental property. But if the rental property is now being sold and being converted, say, to residential, then it's no longer being used as commercial. That's an example where the use to which the property is being applied is changed. You may decide you're going to sell your warehouse, and a church has bought it. So the church religious activity is not vatable. So that's a case where suddenly the premises have switched use in terms of how it's being used, and VAT could enter into play then. In these cases, in the real estate sector, the transactions are sufficiently large and lumpy that when you have doubts, in specific cases, you would have more than ample time to get feedback from the VAT department in terms of how the transaction could fit in terms of VAT treatment. So that might be very important when you are drawing up contracts and there's uncertainty about whether the use to which the property is going to be applied is changing. Now, in terms of what is vatable and what is not, we have here fees and commission charged by realtors. So whether you're getting fees because you rent the property and part of your commission is related to the first month's rent or percentage of the rent on the property as the realtor, your fees, there's VAT that's included in those. So if your fee is 3.5% or 6%, and you want to keep it like that, then you say, well, 7.5% is the VAT. So maybe that fee, inclusive of the VAT, is now something a little bit more than 3.5% because you want to make explicit provision for what the VAT is, because the VAT will be calculated as a percentage of the revenue or the income. For homeowners, we're talking about the condo fees and the maintenance fees as being in that lot, which would mean now that condo associations would need to be VAT registrants because now they'd be a part of the regular filing. And homeowners association may not require a business license, but you may require to be, well, you would be required to be VAT registrants if, in this case, the threshold of $100,000 a year is surpassed. The CAM and other charges that pass along to tenants, those are the examples of that. Now, there may be some components in CAM that are not vatable. Say, CAM may include the pass-through of the property tax or the pass-through of insurance. Insurance is not vatable until July 1. So those are the items that you would want to separate out for the VAT. Electricity is vatable, but you may pass it along in the CAM. When you're passing it along in the CAM, you want to pass along the charges. Well, let's put it this way. If it's $100 of electricity that's being passed along to the client, and it's exactly the same $100 from BEC, then we know that the VAT plus the charge would be $107.50. So if there is nothing else that's happening, then it probably meant that BEC charged $107.50 in total, which included the VAT plus the $100. So when CAM charges are passed along, you could almost look at it as if, okay, stage one, I take the VAT off, I set it aside, I put the charges on the bill. If nothing else is added to the charge, I add the VAT back. And if it's strictly a cost recovery, then on both sides, it'll be the total amount that came in as CAM cost is what you're billing. But that way, you're keeping separate the VAT charge, even in the pass-through, so you can do the proper accounting for the VAT in the transaction. So it doesn't mean that if you're passing VAT through in the CAM charge, that there's necessarily tax or VAT on top of that. You want to make sure that that is not happening, because if it is happening, it will distort. And I'm sure the tenants would be very attentive in terms of looking out for those sort of accounting practices. Now, let's suppose there is a commercial establishment or some other property sold. There is VAT on it. Now, and this is separate from the brokerage fees and the legal fees. But in most cases, the VAT rate is going to be 0%, because it's going to be the sale of a property in many cases where the use of the property doesn't change. Or let's suppose that the property is not a sale of a going concern, but just one business bought it. But if the business itself on the receiving end is a VAT registrant, that business is still entitled to full credit for any VAT that's attached to the transaction. So we will have provisions so that where commercial property change hands and there's a substantial amount of VAT, and both parties are VAT registrants, rather than having the cash exchange hands, you sort of issue the proper, I don't know, I can't recall the exact terminology, but once the seller would issue the equivalent of a credit note or something like that to the buyer to say, you don't pay me the VAT, I don't claim the VAT. So since it's a netting out, there will be a way to document it so that there is no cash that's changing hands. But the transaction itself is documented. So a lot of the times with real estate transactions, it will be a documentation process for what's happening. Now let's suppose I am a business that is not a VAT registrant, and my turnover may be $50,000 or $60,000 a year, and then I suddenly sold the business for $200,000 or $300,000. Do I pay VAT, or am I required to charge VAT on that transaction? Not necessarily, because if you're not a VAT registrant up to that point, a transaction like that would be viewed as just a one-off capital transaction, and with the proper interaction with the VAT office, it wouldn't be the case that the sale is suddenly taxable for VAT purposes. When in the case of a lot of the time, not the timeshare, but I guess timeshare fit this category to some extent, but properties that are in rental pools, people own condos and homes, sometimes as part of large resort developments, and they put those into the rental pools. When I take my house or my condo unit and I put it into the rental pool, there is no VAT charge associated with placing it in the pool. VAT only comes into play when the property is now being rented within the pool and on the income that is earned within the pool from the rent. So that's when the VAT comes into play. So when I supply my property to the pool, it's exempt for VAT purposes. I only focus on the income and how the property is being used within the pool. When you supply your property to the pool, it doesn't matter whether you only earn $10,000 or $20,000 a year rent on it. It's really the pool That's the focus, and the activity is being generated within the pool. So the rental pool itself now is the subject of how the VAT is charged and collected. One of the areas where I think you're very familiar in terms of where the rental pools are very structured is for the second homeowners, often in these cases where up to this point, it's been a give back in terms of removal of the property tax in some of the very large resort developments. So that's one of those features where because you're part of the pool, you get certain exemptions from property taxes because the resort development itself gets those exemptions under the Hotel Encouragement Act. So those are the examples in this third bullet where the you would want to, you're treating them also as being um, rental units that are valuable. Now, when they're rented in this case, in most cases, persons who coming in them stay maybe for a few days or a few weeks. So that's like being in a hotel, similar to the way we would collect the room tax. But the room tax is not applying; it's just the VAT that's applying, and so it's a similar treatment. Now, I don't think it's in any of the bullets, and that's why I was saying that it's important for the real estate sector to see what's happening here in relation to the hotel sector. We all understand that as of January 1, the room tax disappears and it becomes the 7.5% VAT. So wherever the 10% room levy is supposed to be collected, that will be a thing of the past, and the VAT will take the place of that. So for that reason, you're seeing the rental accommodations owned by foreign persons coming in here because it's really just switching from collecting hotel occupancy tax now to collecting VAT. So that's something you want to flag. Vacant land is not vatable in terms of sale. And to be honest, because it's very difficult in the Bahamas because of our zoning being imperfect to know whether it's a commercial or residential often until it gets into the development stage. So if you want to avoid the gray area there, you just leave everything out in terms of the vacant land. So vacant land is exempt in terms of transferring for VAT purposes. Now that's exempt in terms of the conveyance amount, but not in terms of the other fees that are associated with the transaction. Sale of property outside the Bahamas. I don't know how much of that happens, but if your business involves is fortunate enough to be generating income from land sales or property sales in other areas, those are outside of the VAT scope. As a matter of fact, those are services technically that are zero rated. You're exporting your services. So if that is the case, you're not collecting VAT on your business activities outside the Bahamas. If there's stamp tax on property transactions, there's no VAT on top of stamp tax in any case where the stamp tax appears. I'd spoken a little bit earlier about the CAM related issues, and this slide is getting at that. We're talking about utilities and other charges that are included in the rent. You know, sometimes rent is inclusive of utilities, and other times utilities may be passed along as a supplemental charge. In all of those cases, you want to make sure that there's a proper accounting for the VAT. Until insurance is vatable, you want to make sure that if you're passing along insurance charges in some way explicitly, that it is not being billed for VAT. The law says that, and this will apply, you always have to let the recipient know, based upon what it's being charged, what's vatable and what's not. So if there are some charges on the CAM that are not VAT, that are exempt from VAT, you want to flag those so that it is very clear that the VAT that shows up on the bill or the statement is not coming from those particular charges. If, as a part of the rent, the business is allowed maybe, I don't know, a month or 2 months free rent, because maybe they sign a very long lease, there's no VAT. It's important because, in spelling that out, because ordinarily we say that there are certain business transactions where if somebody has an exchange and it's below market or the fair rate, the law says the VAT controller can go behind and say, no, the true market value of this transaction is a different amount, and there's VAT assessed. What we're saying is in the case of the real estate, or in any case, this would just be an example of a discounting. Where there's a discounting at a fair rate, the discount itself doesn't mean that the VAT is on the pre-discount price. So the discounting itself is also taken into account when the assessment is done of how much VAT should have been collected on the transaction. And you can look at the free rent or however you do it as a part of the discount that you put into the contract. Let's suppose that in terms of the periodic supplies, I think this relates partly to a question that came up about prepayment of rent. Or, well, let's say you're paying your rent on a monthly basis. You want to make sure when it comes to the periodic supplies, even though the rate may be quoted on an annual basis or some other basis, the VAT liabilities are recognized, in the periods in which the services would have been earned or delivered. So this is getting at the fact that where you have the periodic payments, the VAT is coming on each payment, even though you may have said the full contract amount is $100,000 a year, but it's being paid monthly because we understand that it's divided over the month. As those payments are due, from a rental standpoint, that's when the VAT is paid. So a $100,000 contract doesn't mean that you declare your VAT liability on $100,000 up front, unless it's $100,000 just for one period, and the one period is up front. So you want to make sure that you do the proper accounting of the timing of the payments. The transitional arrangements are very important, as I mentioned earlier, for real estate, because you're going to have tenants who may not have a renewal of their lease for the next 18 months or 24 months. You don't have to go under the law and write new contracts. Now, you may decide to write new contracts because you don't want them to pay 7.5% more. So you may go in and give them a new contract. But short of that, there should be some sort of notification process so the tenants know that these changes and charges are going to happen. One of the things that we've done inside the government is we've told all of the ministries and agents, wherever you have those contracts, rental or not, expect that come January, those service providers and landlords are going to come to you and they're going to present you with the extra bills for these amounts. And that is independent of them rewriting the contracts. So a part of the preparing your tenants for what's happening is letting them know that this is what's going on. If your tenants are commercial tenants and they're VAT registrant, the VAT that they're paying for their rental facilities and the like are input taxes that will count as credits that they can claim back. So any business that's a VAT registrant, I think unless you are a Public Hospitals Authority or the Department of Public Health, all of your services and supplies, or most, well, I guess I should qualify that because you may have some residential units as part of your properties, but your tenants, commercial tenants, will, in all likelihood, all be providing, if they're VAT registrant, an entire line of products or services that's vatable. So those VAT charges that you assess and pass along to them will be fully claimed back as credit to them from the government. So the question was, why do we even go through that process if that's what's going to happen? Because a part of the entire design and collection process for VAT, even though it's focused on getting this amount from the consumers, is such that the government makes sure that it collects as much of the tax as possible before the last stage. So every time there's an exchange, before it gets to the consumer, the VAT can be collected, the other person can claim it back as a credit. The more persons who are collecting and passing it along, even if there's some fraud in the process, the government collects a larger fraction of the total before the final stage. So it really is protecting the government in the final analysis. And that's why it may seem sort of silly that all of what you collect and the other guy is going to claim back. It probably just means that I may have a little bit more confidence that you're going to hand it over to the government than that he would hand it over to the government. So at least if I am right with that suspicion, when you hand it over to me, I got back some. Now, if he come back in afterwards, he's likely to be reminding me of that and then giving me a little extra as the government because he also collected some VAT in his business operation. So that's why this is happening, and that's a part of the collections and enforcement mechanism. Everybody have an incentive to show that they paid some of it before, and therefore they don't owe as much as what the government may be trying to collect in the next stage. And they have the records to back it up. So that's that's it. Yeah. So if you no, what would happen is that when you charge that on the rent, you give that to the government. But you had some property expense. Property maintenance expenses with that. So you do a deduction, you give the government the difference. When your tenant goes to the government, there may be a clothing store or some other operations. They're going to deduct any VAT paid on their rent and then give the government the difference. So every business in this process is doing the same thing. They're paying VAT on everything that they buy. They're taking credit and giving the government the difference. So it's like you collect, he collect, everybody collect, and give the government a piece of what they collect netting. But we'll get into more of it later. But that's a very important thing to understand in this process. It seems like why bother? Why bother if everything he's collecting, he's charging, I'm collecting from him, he's going to get back from the government. But remember, what we're saying is every one of your customers who are on the receiving end of paying the VAT may not be as honest as you are. So I need to make sure at least you take some of it from them and give it to the government. That's part of what's happening. But what's important to understand in terms of the VAT process also is the qualification for input tax. You can claim tax credits for virtually everything except certain categories of automobiles. Now, in the real estate business, you will probably put a very strong case that you use your vehicle to go to meet your clients at different points. So that might be different. But in some other businesses, they get vehicles as part of their executive perks and the like. And so we're saying those types of vehicles are not considered, I mean, the costs associated with those are not allowable as VAT credits. So, and as well as the fuel and other charges to go into those. But if the vehicle is a part of the business, yes, the VAT credits are allowed. If also entertainment expense, so if you take your clients out to a restaurant or some other outing and you pay VAT and the cost of entertaining them, that's not automatically a case where the VAT credits would be allowed. So you'd be looked at very strange if you go to a restaurant and you ask the restaurant for a VAT invoice, because they will know that in most cases, the clients who are coming into them are not going to be getting from the restaurant a credit that they can claim back from the government. So you want to be very careful about those types of expenses and trying to include those as input credits. Now, in terms of the issues that Bria has sort of given me some heads up on, one is the property transfers. Property that's being transferred between one VAT registrant to another, wherever and however VAT is appearing in those transactions. It means one of the parties is collecting output VAT and the other is incurring input VAT. And that's a case where we're saying that both of them can issue the documentation where there is no payment, so that there is no cash flow impact, say on the seller, and in terms of having to pay this extra amount to the government, and the buyer not having a cash flow impact in terms of paying it to the seller. So that's one of the few cases where you could admit during the transaction not to have the VAT actually paid or collected. But there would be proper documentation that we would spell out very clearly. So and many other cases, if it's the sale of the business and you're valuing all of the assets and the business stays as a going concern, the sale itself is zero rated, which would mean that even other expenses related to the sale itself, become zero rated for VAT purposes. And so there is no VAT charge that is expected to have incurred in those cases. The CAM charges, I think we've spoken about in some length. One of the issues that came up related to CAM to some extent is this idea that when you look at homeowners association, you leave those out of the VAT because it's strictly cost recovery, but the standard is not the same. You have some homeowners association where all of the services that go into the operation of the maintenance expenses, they are contracted. In other cases, some homeowners association have resources internally and they employ and they do some of it themselves. But at the end of the day, the maintenance cost is still the same. So if you're going to have equivalence between the two, you have to be able to impose the VAT on the maintenance fees of both categories of homeowners, whether you're in a strictly voluntary association where you don't have any employees, or in another association where you have a group of employees, because the value of the maintenance is really what the homeowner is paying. Let's suppose in the two cases, the VAT is exempt from the transaction. Well, the homeowner association is outsourcing everything, and all of their suppliers are VAT registrants. They still see their operating expenses go up because of that. So your maintenance fees will be adjusted upward because of that. Now, in the other case, if the other homeowner association has a reasonable share of their expenses based upon internally supplied services, self-supplied services, then the pass-through of VAT may be less, but it creates a distortion in the sense now that this category of residents gets, I guess, an uneven benefit from the fact that by maintenance fees being exempt and they being able to do a lot more of their maintenance internally, it's not valuable. But there is a supply of a taxable activity going on, because it may be security services, landscaping, those are commercial activities. It's just that you've just organized yourself to do so. And if I had a home that was standalone on the corner, on Eastern Road or wherever, I'm probably paying the VAT for all of those services anyhow, whether it's the pool, the landscaping, the security. And so what we're saying is, other than the way you're organized, there is an equivalence. And we want to make sure that the VAT is being applied. It may not be the case that the government is getting any net revenue or any significant amount of revenue from these arrangements, but it's really the transparency of the process that's important. The payment in advance for VAT. I'm certain that this is something that is spoken of very clearly in the VAT legislation. The bottom line is, when does the business recognize the revenue? Typically, if somebody makes a payment in advance, you better be careful not to recognize it as revenue until it's actually being expensed as revenue. So we can provide some more clarity here. My initial thinking is that if somebody is paying rent at the beginning of January for the month of January, that rent is now in the VATable category by the end of that period. Right? So if somebody's paying the rent at the beginning of the month, and that's a part of the VAT period, then it counts for VAT purposes during the month of January. On January 1, it may not be as part of your VAT liability yet, but by January 30, so by the time the service is being delivered, it counts as part of your output VAT liability. By output VAT liability, we mean it's now incumbent upon the landlord to recognize that they should account for VAT in some of the rent that they would have collected. The other point that was mentioned was about, well, the cash basis of accounting, meaning that you should not, just because you bill someone for the charges, be required to recognize the VAT liability. Now, the law says that, as in every other business case, whenever the revenue is recognized, which typically is when businesses issue the bill, not when they receive the payment, that's also when you're supposed to report to the government the VAT liability in terms of on the sale. So the only time that would not happen is if, even in the case of real estate, the size of the operations are less than $400,000 a year, and therefore you've elected to do it on a cash basis. So it would have to be an operation that is under $400,000 a year in terms of the turnover and the receipts to fit into this category. That's very important to understand. And remember now, using accrual basis to recognize your VAT liabilities, this also means that on an accrual basis, you can claim your VAT credit. So if you're getting your electricity bill and you receive it on January 25th, you haven't paid it yet, it's a huge amount, and you issued based on accrual basis sometime in January bills that the tenants don't pay until March or April, even though you may decide to pay your electricity bill in February, all of the VAT that shows up on your electricity bill is also claimable as an input credit in that same period. So when you get billed during a period, you can also use the VAT that shows up on those bills or your payables as input credit. So the accrual basis allows you to also accumulate your input credit on an accrual basis. If you write off amounts that you cannot collect because for whatever reasons the tenants default, there is a mechanism for you to reverse and claim back the VAT on your charges. So in the case of rent, if the tenants skip and you don't get the rent back and you write it off, the law would allow, just like in any other bad debt, for you to claim back from the government the VAT that's associated with those rents. That is, if you are not operating on a cash basis. If you're operating on a cash basis, then your bad debts and write-off have nothing to do in terms of the next step in coming to the government for VAT credit. So that's important. But the short of it is that the accrual basis will be the standard if the size of the operations exceed $400,000 a year in terms of VATable. And I say VATable because, again, you may have some residential, or what we define as residential, and you may have some commercial. It's only the commercial or the VATable side of your rental or your flows that will count for determining where you are relative to the thresholds, not the residential. So those are the general areas that I wanted to flag in terms of the real estate. I didn't talk much about commission because I suspect that there's a fair appreciation that wherever there is a commission in a real estate transaction, it's VATable. Similar to wherever there is legal fees involved, it's VATable. It doesn't matter if the guy who's buying the property lives in New York, if he's buying the property in Lightfoot Key or Port New Providence or wherever, that transaction is VATable. That's not considered an export because that's property or land he's buying in the Bahamas. So if you're the broker or the realtor, you now have an obligation to make sure that those commissions are VATable. If you're an independent broker or agent and you happen to be in the category where your business is not generating $100,000 a year in income, then for the purposes of that, your transactions, your commission is not VATable. So you're below the threshold in terms of the VAT. But once you're above the threshold, then all of your transactions are VATable. If you're a proprietor, you have you sell real estate sometimes, maybe you have a little restaurant and bar and some other stuff, We group everything you own together for VAT purposes as one. So you may be earning $50,000 from your real estate transaction. The store may be selling $80,000, and something else is generating $30,000. Well, you're already over $100,000. So your businesses collectively put you in the VAT loop. So that is also something that is very important for you to understand. Now, I know that there are lots of questions that you may have, but before we go into the questions, I'm going to ask my colleague to talk quickly to you about what's involved on the registration side, and then we can use the rest of the time this morning for Q&A. So I'm going to ask Tim Adderley to come and walk you through what's involved with registration for that.